What's up, investors? It's the one and only the Russian dude, and welcome to another episode, to another Friday of the communistic capitalism and the capitalistic communism. So today we're gonna do something special. Today we're gonna do something new. But first of all, let me apologize for being so late today, almost 20 minutes late. I was doing some final edits for my presentation, today's presentation, and it took way longer than I anticipated. But don't worry, today is gonna be everything straight to the point, no going back and forth. So hopefully today we're gonna still finish more or less like in 40 minutes or hopefully even under. I have many slides, but everything is once again is straight to the point, everything is in the good order, so everything is done. Okay, so first of all, happy Friday, let's do some new stuff. Every single Friday we're gonna do talking about stock market. Drink some beer if you have some. If you're not allowed to drink beer yet, just have some tea, have some coffee, and let's get into it. Okay, so let's get into it. Thank you all so much for joining once again. Okay, and Dido Go asking, Artyom, what signs are you seeing for the stock market to crash? How is the Evergrande situation related to the rest of the world economy or US economy? This time I will not be speaking about Evergrande. I was speaking about Evergrande for more than 1 hour during my last live stream. So if you want to go to my channel after this stream, feel free to go to my channel. And it's gonna be like exactly 1 week ago. It's gonna be last Friday. This is when I was talking about Evergrande and potential how it can influence the whole stock market. First of all, obviously in China, and then probably the whole stock market of the world, and specifically obviously the US stock market, because US stock market reacts almost to everything. And then whenever the US stock market reacts to something, the rest of the markets, they follow the US stock market. So this is also one of the topics for my future live streams, is why I'm mostly only investing in the US stocks or like North American stocks. So obviously not gonna spend too much time about talking about this right now. So once again, in this episode I will be talking about not Evergrande stuff. I'll be talking about the S&P 500, and I'll be talking about that some of the companies, in fact around 50% of the S&P 500 companies, and even more, like around 70% I would say of the companies, publicly traded companies of the US public stock market, I mean, they already trading below their 50 or 200 moving averages, which means that they're already kind of correcting, crashing, going into the recession or anything like this. Everything will be supported by graphs, everything will be supported by charts, everything will be with my own very conclusions. Might be inaccurate obviously, because I'm just a guy on the internet. I kinda see the point in what I'm talking about. It kinda makes sense for me, and in this episode I'm gonna try to show you why this makes sense and why I think these are one of the earliest signs of why the stock market in the US is going probably to crash eventually in the nearest future. We just need to wait for like black swan event. And if you've been watching my previous live streams, you know that the black swan event is basically something absolutely unexpected. So for example, when the stock market is already overheated, everything is at all-time highs, everything is trading very high, at the very high prices. All the stock market needs to start the recession, start correcting itself, is one of this unexpected event. For example, in 2008, it was the mortgage-backed securities, like all these like mortgages, subprime mortgages and all this kind of stuff. Recently it was the virus. The market was not at all-time highs maybe as it is right now, but still market was a little bit overheated, and then virus happened, the whole world basically shut down, and basically we saw the fastest recession, the fastest correction. In this case right now markets are once again at all-time highs, and what we're waiting for is this event which will trigger the correction. And obviously it is almost impossible to predict what's gonna be this event, and especially when this is going to happen. Another thing that Dido Go is saying, the Dow Jones has been going down for the past days, but it is just a normal correction, or can be that interpreted as the beginning of the major crash. And this is the best question probably I will ever get during this live stream, because this question summarizes my whole stream today, live stream today. I will be not talking maybe about Dow Jones Industrial Average. I'll be mainly talking about the S&P 500 and FANG stocks, which is like Facebook, Amazon, Apple, Netflix, Google, and if we can add Microsoft here as well, because these are the companies that bring the whole S&P 500 with them up. So, okay, without further ado, first of all, we always start our live streams with the overview of my portfolio. And as you might already know, September was one of the worst months for stocks, for the stock market in general. So I will not be surprised if your stocks, if your portfolios are also down. In this case, right now, it's the real test for investors, for traders, because whenever everything goes up, you should never be like a genius. You don't need to be a genius to select something and it goes up, because everything goes up. Every single company you select, unless it's extremely bad company, it will go up. The real test of knowledge, the real test of investors or traders' abilities is during market, not crashes, but is during bear markets, is during when the market is trading sideways, when nothing significant is happening. And during this time, specifically during this time, it's the real test. If you can get portfolio in the green zone, if you can make money during bear markets, you are like almost, let's say so, genius, like you are 0.01% of investors or traders. But what you need ideally to target is to not lose as much money as the whole stock market loses. So what I mean by this, for example, when markets are going up like crazy, and you select whatever random companies, the S&P 500, for example, went up by 50% in like 1 year, like this previous year, and your portfolio went up by 70%. This was relatively easy because once again, everything was going up. So it was kinda relatively easy to beat the market. But when the S&P 500 goes down 5%, 10%, if your portfolio can only go down, let's say so 2 or 3%, this means that you actually selected some good defensive positions, whether it's bonds, securities, stocks, like cryptocurrencies, anything you want. The real professionalism of investor or trader is determined during markets like this, when everything goes down. And if you can lose less than index did, this is when you know that you're kind of doing the right thing. So, and this is what I'm going to show you right now in my very own portfolio. So I guess this is how I share. Okay, so as always, the simple portfolio, which is the combination of two portfolios. I already deposited 3,200 in my personal portfolio. I'm not buying yet. I just have money for the next month. So as you already know, the end of the first week of each month, it is when I'm buying some stocks. So my personal portfolio, which is only 2 positions right now, I only opened it last month, so it's not yet like anything significant. And the reason why it's showing me my performance is that I'm up 11%. It is because I deposited money. In fact, I am up only maybe like, I don't know, like 10%, 5%, I would say 5% during in comparison to the previous month. What's more important here is this one, because this is the Tfsa portfolio, the one which I was building for last year and a half, almost 2 years, I would say. Okay, so September, and the simple PC version always rounds up number to just one single digit. I might have minus 2.48%, I might have minus 3.15%, and as you can see, simple just always rounds up to one single number, minus 3% or minus 2%, plus 5%. Unfortunately, it's not then functional, and I cannot wait to get access to some more sophisticated brokerages. For example, when I am in the US, I'm planning to use Charles Schwab, by the way. So this will have way more analytical tools. So for this reason, just this minus 3%, it might be minus 2.5%, it might be minus 3.4%. It is approximately minus 2 point something, to be honest. So it rounded up in worse way for me, but this does not matter because I'm going to show you right now how my portfolio was in comparison to the S&P 500. So this is my portfolio. It is down, let's say, 3%. But if we go to the S&P 500, which is, for example, VOO, in the last month, it is down almost 4%. So even if my portfolio is down, okay, it's going to be 3%, even though it's like minus 2.6, minus 2.8%, I was able, luckily, because investing is also about the luck, luckily I was able to not lose as much money as the S&P 500 did. And this is what I was talking about, that during these moments like this, when you can save your money and not lose as much, it is when it really showing that you selected some good, proper companies. And during the last week, because majority of drops was basically during this week. And let's compare S&P 500. S&P 500 during last week fell by almost 2%. It's down 1.98%. While my portfolio, once again, is going to be rounded up. My portfolio in the meantime is only, no, it's personal. Well, I wish it's gonna be up 122% the last week. So TFSA, okay. TFS, why it's again showing personal? Okay, I guess I'll switch from here. While my portfolio is approximately in 0%. So the S&P 500 this week alone went down almost 2%. I am kind of relatively in the neutral zone. I just lost like $60, so it's around like 0% performance for me. Compare it with people who are like holding like Palantirs, I don't know, Teslas, all these like companies that are hyped companies, cool Robinhood boys companies. I'm sure they're down like 5+%. So, but at the same time, these are the people who are easily beating the index, the stock market, when everything was going up. But if correction happens soon, eventually next month, next year, this is once again, it's gonna be when the real investing and trading professionalism is gonna be tested. How much money you can save, not how much money you can make, because long-term investing is about protecting your downside, not focusing on increasing your upside. Okay, let me make a sip and we're gonna go to the next segment. Mr. Araya, welcome. Now we're just waiting for Mr. Pete Griswold, our friend. Mr. Araya says, hey all, just tea for me as I'm meant to be still working. It's fine for me. As soon as you finish working, go get some beer. I don't know if you're drinking or not, so I'm not forcing, not making anyone alcoholics or anything like this. It's Friday, that's why this stream is perfect time. It's Friday after work, just when everything is done, everything is good. You have long weekends ahead of you, or like maybe just regular 2 days weekends ahead of you. Now you're watching about stocks, talking about the news on the stock market, what happened during the last week, get some beer. I think it's just perfect timing for this live stream. Okay, and Sigma Enigma, welcome Sigma Enigma, it's some new faces here. How can I become Russian? You need to be born in Russia. If I'm trying not to be funny or anything like this, I guess you need to be born in Russia, get married with some Russian person, women, man, anything you want. But anyways, if you want to be Russian, just accept the ideology of communism, accept that this is the only one true politics, and this is how you can become a real Russian without getting to be born in Russia or marrying Russian or anything like this. Okay, individual positions performance inside my boss portfolios. So Apple is down 2%. The next one is AbbVie. AbbVie is, everything is going to be more or less down, I'm assuming. But AbbVie is up 2%, which is good. AMCR is down 0.68%. Bank of Montreal is down 0.4%. Caterpillar, my favorite Caterpillar, is down 0.6%. Carnival Cruise Line is, let me guess, it is, wow, up 5%, a little bit even more than 5%, not bad. Next one is Corsair Gaming, it is down 4%, perfect, because next week I am buying Corsair and I want it to be as slow as possible, because next week I'm buying it. The next one is EOG Resources, and this up, what, almost 10%, okay, I gotta take it. The next one is iClean Energy ETF. It is down 3%. The next one is Chinese ETF. Chinese Internet ETF is down 2%. The next one is Lockheed Martin. The most boring position I would say in my portfolio is down 0.3%. The next one is Southwest Airlines and it is up 3.7%, not bad. The next one, the next one is 3M Company and it is down, 2.6%. The next one is Nordic American Tanker. Wow, It is only this day, it is up 12.5%. And if you're watching some of my previous streams, you already know why I'm holding this position. This is just a gamble position. And then, what? You always know, whenever you are having some money to play around, whenever you have a company that you do not take seriously, this is what's gonna happen. So this is the company that I only have like $200 invested in. It is just pure gambling, pure speculation. So I'm not treating this seriously, obviously, and it is up 28%. I'm gonna take it. Why not? Okay, so the next one is the New Core Corporation. It is down 1%. Next one is Store Capital, my favorite REIT. It is down 3%. And the last one is the ESG ETF. It is down 2.35%. This was my Tfsa portfolio, where I don't need to pay taxes. And now only only two companies in my personal portfolio. These are the companies that I do not need to pay, that I need to pay taxes on as soon as I sell them. And these companies are very simple. This is the Airbnb, obviously, and it is down 0.8%. And the one which I am strongly believing the most, I would say, what? Silvergate Capital up to almost 11% in one day? What happened? I missed it. Oh, I need to take a sip, and I want to just enjoy this beautiful graph. I had no idea. I do not check my stocks every single day. Like I was telling you previously, I only check my stocks with you. Every single Friday after work, when the week is over, this is the first time I'm checking my stocks. This is one of my biggest positions that I want to build in the future. Right now it's like in the middle, I don't know, it's like 5% of my portfolio is in this position approximately, maybe even less. But it is already up 26%. That's not bad. That's absolutely not bad. Okay, so this was my portfolio performance. So many people left during my portfolio performance part of the stream, so I guess we need to make it shorter next time. But for now, let's go into our main segment of the stream, which is why I think that the stock markets is very it's very unstable position right now. So okay, we begin with this article from Morningstar, and this is why you all came here for. This part of the live stream is where I need your full undivided attention. We're gonna go over this part of the live stream pretty quick, I would say maybe 20 minutes maximum, we'll see how it goes. But this is why you all came here for. Why I think that right now the correction, the crash, the recession, whatever you wanna call it, has already started, but we just don't see it. And this my whole segment of this presentation starts with this article from Morningstar. Morningstar is a pretty reputable source. It's basically like Wall Street Journal, Bloomberg, and all this kind of stuff, Forbes. And it says that more than a quarter of Nasdaq 100 stocks are in bear markets. Wall Street is a buying opportunity. The reason why it's called like bear markets is because they're going down or they're not going up, or for example that even if they're having some kind of good financial reports, quarterly reports, the stock market are either selling them or not reacting at all because they're fixing their revenues already. For example, all this already is inside the price. So and it says here stocks down more than 50% from their 52-week highs, include Pinduoduo, Baidu, these are two Chinese companies, Zoom and Peloton. And this is obviously just 4 companies, and I'm sure you heard about the last 2. So this is just the beginning, basically. Next we see here is that I took some of the companies from my watch list, and I did graphs for them that 6 months performance. For example, and these are the companies that are the small cap companies, medium cap companies, big, large cap companies. So these are the companies that has like market capitalization like $50 million all the way to several hundreds billions of dollars. So I'm not just taking like very small companies. I'm taking companies from different sectors, different industries, and of different capitalization. So first one is Vertex Pharmaceuticals. This is obviously biopharmaceutical company, and it is down more than 16% in the the last 6 months. The next company is Caterpillar, my favorite Caterpillar, and this is a large cap stock. It is down almost 17% in the last 6 months. The next company is Corsair Gaming. You already know this is one of my favorite companies. This is small, medium, cap company. It is down almost 23% in the last 6 months. The next company is Micron Technology, semiconductors basically, down almost 25% in comparison to the last 6 months. The next one is Taiwan Semiconductors, also semiconductors, but way bigger company than the previous one. It is down almost 11% in the comparison to the previous 6 months. The next one is Airbnb, relatively new company. So you see, I do not just include also Dow Jones Industrial Average companies, like big companies, mastodon companies. I'm also including companies that are kind of recently went public, such as, for example, Airbnb. It is down 7% in the last month. The next company is ChargePoint Holdings. I think this is the smallest capitalization company inside this list. It is down almost 32% in the last 6 months. Next company, that's it. Next slide out is gonna already another part of the presentation. But as you can see, I showed you companies from different sectors, different industries, and of different capitalization that are not these giant trillion-dollar companies. All of them are relatively down. Like some companies, yes, they might be up, but I just took some of the companies from my watch list and I saw their 6-month performance. Majority of them were down, which confirms my very first slide that more than quarter of the stocks are already in the bear market. So I see some, okay, Mr. Rice says that got some Micron, not doing too well. Exactly. So you see, and also they did some not so good news recently, or financial report was not so encouraging. It went even lower basically, okay? And so now, next thing happened. What I think before I go to the next slide, also extremely important. So just let me get a breather, let me get a sip, and I'm gonna go straight right into it. Okay, next segment of the presentation, extremely important once again. And this is probably going to be the most important segment of this part of the presentation. We finished completely the second quarter financial reports. So, you know, like there are quarters in financial year. So first quarter, it's like what, January, February, March, then April, May, June is the second quarter, July, August, September, and we just finished September is the third quarter. And companies will start now issuing their third quarter results, because third quarter, theoretically, some companies, they have their own internal quarters, but generally speaking, September is the end of the third quarter. This is the end of the third quarter when companies will start releasing their financial reports for the third quarter in the nearest future. Within the next couple of weeks, we start the earnings season to come back. And I honestly think that the next earnings season, the third quarter earnings season, will be very, very bad. First of all, because commodities are extremely expensive. You all remember about steel prices, lumber prices, gas prices, oil prices, almost everything goes up. So you can also see one of my previous live streams when I'm talking about also like commodities price and all these kind of things, okay? So commodities, container shipping rates. This is one of the things that I was focusing on the most, container shipping rates. It gets so expensive to ship raw materials or like finished goods from abroad, from around the world, from China to America to North America, etc. basically, okay? And besides these rates being 10-15% higher than they normally are, which basically means if a company is barely making any money, and now commodities prices are so expensive, and the shipping rates are so expensive, and also when the ships come, for example, in Los Angeles port or anything like this, they have so much waiting time. So even though they arrive to the North America, they still have to wait for weeks or even maybe sometimes some worst case scenarios, months, just to be unloaded. So this creates delays. Prices are high, so much delays. Consumer confidence is going down as well. I think I was talking in my previous live stream about consumer confidence. So people are not spending that much money anymore. For example, whenever we were in pandemic, obviously like restaurants, shopping malls, all of these things were closed. As soon as we were allowed to be back in malls and restaurants, everyone was like, yay, let's get back to normal. Everyone was like eating in restaurants 2 times per week, 3 times per week, every dinner. Maybe some people, they're going to the malls, finally get back to normal. But now it's okay. It's like, okay, yeah, like malls are open. We're not that much confident. We're not much optimistic about doing these things again. Right now it's again, let's say so, getting back to normal, and hopefully it stays the same. So people do not spend that much anymore. People just, they start spending appropriately. They don't buy things they don't need anymore. Maybe they don't just go to the mall just for the sake of going to the mall. They maybe go to the mall just to actually buy something. I'm sure it does not apply to every single person. I'm just speaking in general. So for this reason, so many companies, I think, and obviously there are way more reasons than this, but this, I think, that the main reasons why so many companies will have very bad financial reports, because basically everything is expensive and consumers are not that much willing to spend their money anymore. In addition to that, there is no more like stimulus checks. Like Americans got 3 stimulus checks, more than $5,000 combined of literally free money for every single US citizen, resident, like, or a legal alien or anything like this. Every single person got money, spent this $5,000. Some people spend it on the stock market, some people spend it on food, on clothes. This money, most of this money was spent. I'm sure that very few people just kept this money, put them in the savings account and did nothing with this. This money went somewhere. Now there's no more money, and basically people do not spend that much anymore as they used to, like even 6 months ago. For this reason, I expect, once again, to summarize, that the next reporting season, which is the next third quarter reporting season, earnings season, will be pretty bad. It's not going to be maybe awful, but it's definitely going to be not as good as it used to be. Also, like all this like used car prices, for example, there's going to be one company I'm going to be talking about, Carmax, that sells lots of used cars, buys and sells used car prices. And remember that used car prices was the second biggest contributor to the inflation. So the first one was the rental car prices, and it went up by like more than 70%. And used car prices, they went up by more than 40%. So obviously now the car prices start to, let's say, so stabilize. And also there's like chip shortages, so there's almost not as many new cars, which means that people basically just keep driving their new cars. So not many people buy cars, either it's new cars or old cars or used cars or anything like this. And I will show you Carmax specifically what I'm talking about. And before earnings season has started, some of the companies already started releasing their financial reports. And these are either reports for the third quarter already. None of them did it yet, maybe some of them did, but these are like late second quarter financial reports. And one of them was not Best Buy, but Bed Bath & Beyond. If you're from North America, or I don't know where else it exists, this is the like a North American version of IKEA, let's say so. Smaller IKEA. You can go there, you can buy like some basic furniture, like some household items, like all these kind of things, let's say so. And this is what Best Buy Beyond, your device is no longer protected, it was never protected. This was the financial report, the most recent one. It came 2 days ago, if I'm not mistaken, from Bed Bath & Beyond. So this company reports second quarter results, delivering positive operating cash flow, but financial quarter 2 non-GAAP earnings per share of only $0.04. Earnings per share was only 4 cents per share. And they missed it by 48 cents. So they missed the estimations by, let's say, I think it's, if my math is correct, by 90%. GAAP, General Acceptable Accounting Principles, EPS of negative 0.72 misses also by 1.25, which basically means that estimations for GAAP EPS were in positive, in green, but the GAAP EPS was actually negative. Awful, basically, financial report. Even the revenue of only almost $2 billion, it is down 26% year to year, which means that like quarter of revenue is already not getting as, because once again, I was telling you, people are so excited. Wow, let's buy this, let's buy that. Finally, we're getting back to normal. And that's it. It basically slowed down. People are not going back to stores just for the sake to go out or anything like this. And this revenue, even though it is also was down 25%, so forecast estimations for this revenue was already low, they still missed it by $70 million. In addition to this, in addition to poor financial performance, every single thing they missed. They also cut their fiscal year 21 EPS forecast. So they were saying basically that originally they were saying that in fiscal year 21 their EPS will be approximately somewhere between 140 to 155. They, Bed Bath & Beyond themselves said now we're reducing this almost in half. Like even I would say the lowest point, which is what's $1.40, now it's 70 cents. So they cut their worst case scenario in half. And so as you can see, this is just the beginning. That's what I'm saying. I think that the third quarter of financial reports will be awful. And this is just one of the companies that did their reports. It was once again, it was late second quarter, but we're still in the beginning of the very beginning of the third quarter. And this is how the stock reacted of Bed Bath & Beyond. In 5 days, the stock is down almost 28%. And if we take, so yes, this report was on Wednesday and the aftermarket or pre-market Thursday or aftermarket Wednesday. So after the report, stock went down by, I would say, more than 20%. But just in 5 days, just since the beginning of this week, the stock is down already more than almost 28%. And this is just one of the first companies that started reporting their financial results. So before we go to the next one, let me get another sip. Mr. Araya wants some beer now. Don't worry, bro. So as soon as you get home, get some beer if you want. You can even play this live stream once again and drink beer with me, or just get ready for the next live stream. We can do it no matter what, so don't worry. Beer is not going anywhere. Beer is gonna here to stay. Okay, next one, I was talking about the company, another one, Carmax, like 5-10 minutes ago. Carmax is the company also in North America that buys and sells used cars, primarily. It's at least what's known for. This company also, the report also came like a couple of days ago, misses Q2 earnings estimates. And this is the company, once again, that deals with used car prices, which, once again, the used car prices started to go down. Chip shortages, so there is not as many old cars, it's not as many new cars, and people just prefer to drive whatever they already have. So it was relatively obvious that they will kind of miss their Q2 earnings estimates, which they did, as you can see. They missed their Q2 earnings estimates, and also their future forecasts for the next quarter, third quarter, were also not as good, which basically means that they were also saying that we most likely will not get as good financial results next quarter. We might reduce our estimations, don't hope too much, the used car prices are going down, chip shortages, all these kind of things. This is how the stock reacted. Almost 13% down in the last week. So that's once again, these are just first two companies that, let's say, so in some theoretical way, they opened the third quarter earnings season. They opened, and this is how they opened it. These are two biggest companies. Of course, some other companies are also releasing their financial reports, but these are the companies that are like small cap, like nano cap or anything like this. So I was not paying attention to them. But these are relatively big and famous companies. Just look at how they reacted. And this is just the beginning. Okay, this is how Bed Bath & Beyond affected other similar retailers. So Kohl's, if I'm not mistaken, it's almost relatively the same as Home Depot. It's basically you can buy like construction things, and also like household items, things around the house. Macy's is the place where you can buy like clothes, for example, mainly clothes of like all the brands. Ralph Lauren, I don't know, like Gucci, Louis Vuitton, like all this kind of stuff, like Team. I forgot the name. So this is basically a place where you can buy clothes. Best Buy, it's basically electronics, one of the most famous places where you can buy electronics. Nordstrom is the same as Macy's, but it's more premium brands, once again, Gucci, Louis Vuitton, and Balenciaga, all this kind of stuff. TJX companies, I think it was also clothes. Dick's Sporting Goods, sporting goods obviously, and Gap. Gap is obviously clothes. They have not released yet their financial reports, but just looking at the financial report of Bed Bath & Beyond, how bad it was and how awful their forecast for the next financial quarter was, just by looking at this, Kohl's went down by almost 14%. Macy went down by almost 9%. Best Buy went down by 3%. Nordstrom went down by 9%. TJX went down by almost 5%. Dick's Sporting Goods went down by almost 5%. And Gap went down by almost 7%. And this is even before they released their financial reports. So as you can see, investors are already very, very afraid of what's going to happen next. They prefer to lock in their profits right now and just like pray that their estimations are going to come true. This is just the ripple effect of one company. Once again, they haven't even released the reports yet. And this is what I was talking about basically. So this is from Morgan Stanley Research, Bloomberg, source of the graph is the Bloomberg. Let me make it a little bit bigger so you can see it maybe a little more. So it says that the S&P 500 has remained durable, but damage has been done under the surface. And this is literally one of my first sentences of this live stream, is that the stock market is already happening, we just don't see it. And this is more professional way of saying it. And this graph shows percent of members with max drawdowns of more than 10% since May 2021. Basically since the beginning of the second, third quarter. Okay, and it shows that 56% of the S&P 500 companies, 56, more than half of the S&P 500 companies are down more than 10% since May 2021. Okay, since May 2021. You remember I was showing you Vertex Pharmaceuticals, all these companies I was showing you in the almost very beginning. This is down 26%, this is down 12%, this is down 15%, this is down 16%. So the question here is, why the S&P 500 is still going up all the time? Did I switch it? No, I didn't switch it, okay. And this is the reason why the S&P 500 is still never ending going down. This is one of two reasons. So this is the first reason. Also pay attention to these two reasons why the S&P 500 is still up. I'm sure it is the same for the Dow Jones Industrial Average. So this is the quote from Investopedia. You can check it yourself. I didn't have time because I was already late 15 minutes. I did not have time to find more professional source, but Investopedia, if you're an investor, if you're a trader, I'm sure you know about this. It is relatively reliable. And it says that each of the FANG stocks, which is Facebook, Amazon, Apple, Netflix, Google, sometimes it's called FAMG, which is Facebook, Amazon, Apple, Microsoft, and Google. Sometimes they call it FANG Plus. But the idea is still the same. So on the Nasdaq exchange and is included in the S&P 500 index. Since the S&P 500 is a broad representation of the market, the movement of the market mirrors the index's movement. As of August 2021, which was basically previous month, but we just finished September, so they did not have time to update it for September, because literally yesterday was still September. The FANGs make up almost 20%, about 19% of the S&P 500, which means that only 5 companies make 1/5 of entire S&P 500 index, of almost entire stock market in the US. Because S&P 500 in return, I think it's almost like what, 80%, 70-80% of entire stock market. Which basically means if you add to this Facebook, Amazon, Apple, Netflix and Google, you also add Microsoft here, which is also a $1 trillion company. This is going to be more than 20% of entire S&P 500 is located inside these 5-6 companies. So, and because of this, because these companies are still up, and I will show you once again with all the graph, with all the proof, with all the charts. I'm not saying anything out of thin air, not creating anything out of the big blue sky. Everything will be supported with the graphs and charts. So, but keep in mind right now that more than 20% of the S&P 500 is supported by just 5-6 trillion dollar companies. And now, once again, I need to do like this. And now these companies. You remember, I was showing you almost in the very beginning, I was showing you these companies like Vertex, Caterpillar. I was showing their 6 months performance. All of them were in red. And now I'm going to show you Facebook, Amazon, Apple, Netflix, Google, and Microsoft also with 6-month range. Look at this. Facebook up 11% in the 6th month. Apple up 13% in the last 6 months. Amazon up 1.75%. It's basically stagnant, but still at least it's not going down. It is almost up 2% in the last 6 months. Netflix up 13% in the last 6 months. And finally, Microsoft is up 16% in the last 6 months, which tells us what? That 20% of the companies, which is only 6 companies, 6 companies of the entire S&P 500 index are up, while the rest is already down. So, and these companies, it what helps the S&P 500 to be relatively kinda at least not falling down as much, even though previous month was pretty bad. Previous week and previous month was pretty bad. The S&P 500 is down like 3.34%, okay? But these are the companies that still keep this index afloat. And let me see. Простыми словами, как насчет русского для своих русских фанатов? I wish I can say things in Russian, but I was studying investing, trading, finances in English. So for me, it is way easier to speak about these things in English. Maybe in the future, whenever I'm hopefully a little bit bigger than I am right now, with only 6 majestic, incredible people watching me. So thank you so much. It's only 6 of you, but it means it feels like I'm being watched by thousands of people, because just imagine, I'm like some random dude, Russian dude in Canada and whatever, making this stupid weekly Friday live streams, rambling, always trying to crash the stock market. And there are some people in the world who take time of their day to spend with me, to watch me. Even if it's only one person, it means already a lot. So that's what I'm saying. Very grateful that all of you, every single one of you is watching, but unfortunately, as for now, I'm not gonna be able to speak that freely in Russian. Even though Russian is my native language, obviously, everything I know about investing and trading, I was studying in English language, which basically means that speaking in Russian, paradoxically, will be harder for me. And okay, so hopefully you still understand, bro. Okay, so this is the first reason why the S&P 500 is still up, and why everything is like, oh, S&P 500, the stock market is still up, we are good, like there is no problems, the S&P 500 goes up all the time, even though 56% of the companies are already more than 10% losing of their valuations. Some of the companies losing almost half of their valuations, but for them it does not matter, because all they see is that S&P 500 is still up, and this is only first reason. And the second reason, oh, and Google, by the way, yes, Google is also up 23% in the last 6 months. And this is the second reason why the S&P 500 is still up. Because companies, corporations are doing so much buybacks. As you can see, the amount of buybacks they are doing right now is the biggest since the beginning of this chart, since basically 2009. So for the last 12 years, this is the biggest amount of buybacks that corporations do. And buyback, for those of you who do not know, buyback is a very simple thing. For example, companies like Apple, there are obviously Apple shares, and Apple as a company can buy its own shares from the market. For example, on the market there's like, let's say 10 million shares, and Apple is like, okay, let's buy 1 million shares from the market, because for whatever reason they might think it's undervalued, they might want to decrease the number of shares on the market, floating on the market, or they might just increase their share prices, whatever. Like there's so many reasons why they can do buybacks. Or for example, they have so many cash on hand, they literally don't know what to do, they don't need to do research and development, there's no mergers and acquisitions, nothing like this, and they're like, okay, let's just buy back our own shares, increase the share prices, and make our executives more rich, because every single executive in the publicly traded company holds shares of its own company, obviously. And companies are doing so many buybacks. As you can see, right now is the highest level of buybacks in the last more than a dozen of years. Which means what? Companies are doing buybacks. Why? Because in the future, it's very likely that Biden administration wants to increase corporate tax rates, that the Biden administration wants to introduce buybacks, they want to do taxes on buybacks. So in the nearest future, very most likely buybacks are going to be more expensive than they are right now. So companies, corporations also, besides them having so much cash on hand, they are doing buybacks because now is the time, because in the future it's going to be more expensive to do buybacks. And the reason why they're doing buybacks is just like I told you 1 minute ago. The company is doing buybacks, which means that number of shares outstanding on the market is reduced, which means that the share price goes up. And even though the company buys back its own shares, the insiders, executives, CFO, CMO, CEO, all this kind of chief executive officers, even directors and some people inside the company, their own shares become more expensive. And also, once again, first reason is because in the future it's going to be more expensive. And second reason is because the Christmas is coming. You need all these huge bonuses. You need to buy Christmas gifts. You need to buy Christmas presents, all this kind of stuff. So all the executives want to sell their shares and will most likely be selling their shares, at least some of them, or not all of them, obviously, for this fat Christmas check, which is going to be hundreds maybe of millions of dollars for some people, tens of millions of dollars for some people, for sure. And this is the second reason why S&P 500 is still going up, because there's so many buybacks. And this is when I'm going to expand on this thought once again. And guess who is the biggest buyback companies? The biggest buyback companies are similar suspects: Apple, Google, Facebook, Microsoft, and other companies, obviously Oracle, JP Morgan, Berkshire Hathaway, Bank of America, also big large cap companies of hundreds of billions of dollars of valuation. These are the biggest companies that are doing buybacks. Second reason why the S&P 500 is still up. The rest of the market, more than half of the companies are down, while FANG companies, Facebook, Amazon, Apple, Netflix, Google, Microsoft, these are the companies that are still up. And these are the companies that are still doing buybacks. And this is also one of the reasons why they're still up, basically. Because of these 5-6 companies, the entire stock market and the S&P 500 is still up. And this is why not too many people at least see that actually the stock market crash already starting to happen, at least in some sectors, in some indices, in some stocks. Maybe not crash, but correction for sure. It already happening. It is already happening. And guess what? As soon as these companies, FANG companies, these big companies start correcting as well, this is when entire stock market starts to go down. Just give me a second. This is when entire stock market starts to go down. And when entire stock market starts to go down, guess what starts to happen? Let me see my next slide. Yes, one windmill. As soon as the entire stock market starts to go down, people start panicking. People will start selling their shares. Not everyone, of course, like long-term investors, they just hold no matter what. Whenever there is the dip, they buy it and stuff like this. But as soon as the stock market starts to go down, as soon as FANG companies start to go down, not just regular people who will be afraid, who will be scared, they'll start selling their own shares. Also, lots of institutional investors, they are not trading like personally. They have algorithms. They have like notifications. I don't know how they call, like, you know, as soon as the S&P 500 reaches 4,300, it's like automatic sell. It's like it's machine selling. It's robots. It's robo advices, machine trading. It's algorithms. As soon as some certain companies reach their targeted low prices, algorithms will be selling this. And these are institutional investors. This is not just like you and me. If we sell $5,000 worth of Apple shares, it's not going to do anything to the Apple share price. But if institutional investor sells $50 million worth of Apple shares, this will definitely have some impact on the stock price of Apple. And as soon as more of these algorithms start selling, it's going to be chain reaction. More and more and more algorithms start selling, and only these 5-6 companies are keeping the S&P 500 up. These companies will be down, which means that even though previous companies, smaller companies, which are not like trillion-dollar companies, which are already down on average 20%, they will go even lower. Because still there will be machine selling, there will be people who are scared, who are afraid, and they will still be selling. And this is the moment when we're gonna start seeing full scale correction, maybe all the way to crash or even recession. Okay, Mr. Rice says, interesting. I only thought companies bought back when they thought the stock was undervalued. Yes, this is one of the reasons why companies do buybacks, but also it's just because they have so much money, or because when they want to make their executives more rich. There's many reasons why they can do buybacks. And yes, one of the main reasons is when they think that the stock is undervalued. Okay, and so now one of couple of two last slides, I think, if I'm not mistaken, and this is once again the S&P 500, which does include $1 trillion fund companies and Russell 2000 index. All these graphs will be, I should have put them in the same screen, but I was just in a rush, so unfortunately, hopefully you're gonna forgive me for this. So the S&P 500 in last 6 months, it is still up 7%, mainly because of buybacks of fund companies and fund companies themselves. But if you take a look at smaller companies, because Russell 2000 are the companies that are smaller capitalization, these are 2000 smallest companies of the US, of the publicly traded companies in the US. These companies which do not include fund companies, this is already negative 1% in the last 6 months. So it's not going down crazy, but it is not going up as well. It is, for the last 6 months, it is absolutely stagnant. It's not making money at all. Just let me check if I have more. Yes, I have one last more screenshot after this, and we're gonna wrap it up very, very soon, so don't worry. So as you can see, the S&P 500 is still up, while the rest of the market is, which is Russell 2000. If you combine Russell 2000 and the S&P 500, this is gonna be, if I'm not mistaken, more than 95% of entire stock market in America, maybe even more than this. So this is basically the representation. The biggest companies which hold the market up are still up. The rest of the market is already basically stagnant, not going up, not going down. And if you've been watching my last live stream, very interesting thing I've been talking about, what will be the black swan event, if it even comes to real life or anything like this. You remember I told you that the stock market's crashes come when you least expect them. Whenever everyone is like, okay, everything is good, the stock market is healthy, all these P ratios of 300 on average is okay because we expect huge growth because Tesla is not just a car company and all these kind of things. When you least expect it, this is when the bad things happen. Because if everyone knows that the stock market crash is coming, if everyone knows this, obviously they'll get ready for this, they will sell their position, that they'll hold cash and do nothing. In this case, the stock market crash will be basically either stagnant or it will go down slowly. But why stock markets always crash so fast and so much? Open 2008, 2000 dot-com bubble, virus crisis, all these kinds of stock markets crash almost vertically because they happen because something unexpected happened when no one was ready. And this is the reason why I'm showing you this graph. The last time short interest of the S&P 500 was 1.5%, it was during dot-com bubble. Whenever, no, you know what happened, everything related to internet was going up like crazy. At this point, everyone was like, okay, internet is the future, there is no way it goes down. Everyone was calm, everyone was sure that stock market, yes, it's overvalued, but in the future, when companies start making crazy profits, the valuations will get back to normal by themselves. Everyone was chill, everyone was relaxed, everyone was flexing, everything was good. And then this happened, the stock market started crashing. This was one of the fastest, one of the deepest recession correction crash in the history of the stock market, known as the dot-com bubble. Right now we see again the same. Everyone is like, yeah, chill, don't worry, like everything is good, we're coming out of recession, the virus is defeated, Tesla is not just a car company, Tesla will be 17-20 trillion in 10 years from now, all these kind of things, nothing to worry about. So as you can see, short interest of the S&P 500 is again at 1.5%. Which means that so many people think that everything is normal, there is nothing bad gonna happen, the Federal Reserve will keep printing money, that Jerome Powell has everything under control, everything is good. Once again, bad things happen when you least expect them. And right now, I think that the stock market least expects something bad to happen, except me. As soon as I accept it, as soon as I accept that the stock market is healthy and everything is good, this is when everything will crash 100%. As soon as I protect you from stock market crashing, as soon as I'm doing these live streams saying that the markets will crash next week, the markets will crash next month, the markets will definitely crash next year, as soon as I keep making these live streams, they will be going up. And don't worry, I'm not selling. I'm not saying you should sell. If you're a long-term investor, that's just dollar cost average. Every single month, buy the same stocks using the same amount of money in the same day of the week. That's it. Don't worry. I'm going to do the same. Yes, the market will crash eventually. I don't know when. Within next half year, within the next year, it will crash eventually 100%. But when it does, and if I buy, I mean not if, but when I buy stocks at a very discounted price, some of the stocks in my portfolio will be down, I would say 50%. And if I buy it, this will significantly reduce my average cost basis. So for example, let's say, so my right now cost basis for Caterpillar, for example, is $120. But if Caterpillar goes down to $70 and I buy it at $70, my average cost basis will be not 120 anymore. It will be around, let's say, so $195 at this point already. So you see, I will just keep buying. Timing the market is impossible. So once again, this is my plan, this is my strategy. I'll be in the market. I'll be making these videos which will protect the market from crashing. I will always be bullish and long term on the stock market and bearish on the short term stock market, at least until it crashes. And that's basically it for now. So if you have any questions, I think it was very good live stream today, and Mr. R says it's ticking time bomb. It is exactly that. It is ticking time bomb. As soon as something bad happens, black swan event, this will create the chain reaction. FANG stocks will go down, they will bring down the entire stock market with them, everything will be bad, everything is so much overvalued right now, so everything will be down at least 20-30% from their all-time highs on average, which means that some companies will be down 70%, 80%, some companies will even go out of business because of so expensive raw materials, not too much consumer confidence, and so expensive container shipping rates. But we're gonna see as for now what's gonna happen in the future. So this was the Russian dude, first live stream, drinking beer, drinking piva. Hopefully you enjoyed. Hopefully some of this makes sense. Thank you all so much for joining. I would never be tired of thanking you for joining my live streams. I think it's a blessing that you are watching me. It's incredible, like I told you. So many YouTubers, so many people, and you decide to spend this 1 hour every single Friday with me. So thanks so much, and see you next Friday.